Welcome to the LDC's application workshop. We started these workshops because the vast majority of LDC clients are first-time business borrowers, and the process can seem a little intimidating. So what we want to try to share is everything that's needed to make your application complete, and how we underwrite and how we get you to a loan approval. But first of all, who is the LDC? We are a nonprofit. We're mission-based small business lenders. We provide capital only to small businesses that are unsuccessful, in getting bank financing. Basically, it's startups, entrepreneurs, a lot of the industries that banks have a hard time lending to. We could be their first step in getting capital. We are what's called a certified community development financial institution, or a CDFI. And what that really means, when we're audited, both on the federal and the state level, they're looking to make sure that we're meeting mission, that we are supplying capital to small businesses that are unable to secure it through traditional sources. How we work is we actually borrow money and then we re-lend those monies back out. You can see there's some municipalities, some federal sources, private foundation. The best thing is that we don't ask these organizations for loan approval. We report after the loans are been made. All of our loan decisions are made by LDC staff or by our board of directors. There are a couple of new programs that the LDC has. We've partnered with some municipalities and organizations in response to the pandemic. The first is the City of Charleston's Small Business Relief Fund. These are for small businesses with less than 25 employees and less than $2.5 million in gross revenues annually. Loans up to $100,000. There's no collateral required and no personal guarantees required, but these are loans and they are meant to be repaid. That's why we will ask for some documentation, current finances, past financial information. We need to determine that this is still a viable business. And we just need a memo that describes how the impact of the pandemic affected your business. But that doesn't necessarily mean only in a negative way. Maybe your business found an opportunity or a way to pivot. It's just, with these funds, it'll strengthen my business and help me grow it. We have a similar program with the City of Goose Creek. It's a little bit smaller. It's loans up to $25,000, but it's low rate, only 4%. Same thing with the town of James Island. However, the town wants you to have a brick and mortar location. Both the City of Charleston and the City of Goose Creek allow home-based businesses. And then we have a partnership with LAMPC, or the Low Country Alliance for Model Communities. It's available for 7 North Charleston neighborhoods. It's Accoby, Chicora, Cherokee, Union Heights, Howard Heights, Windsor Place, 5 Mile, and Liberty Hill. These loans are really all about job creation, in that if you hire someone in those neighborhoods, up to 25% of the principal of the loan can be forgiven. There's no interest for the first 6 months, and interest doesn't accrue for 6 months, and there's no payments for 6 months. And it's also a 4% interest rate. So if you're not in those neighborhoods, this is not in direct response to the pandemic. Where do you go? And it's unlikely that a business is ever funded just from one source. Now, for a lot of startups, we get some phone calls asking what grants are available to start a business. And unfortunately, this is where we tell them to get a grant to start a business. There really isn't any such thing, except there is something called an individual development account, or an IDA. This is a financial literacy program where you take a few courses and you save $1 and it's matched by $3 up to $1,000. And spouses can do this. So they save $2,000. Now all of a sudden they have $8,000 to buy a home, to go to college, or to start a business. The caveat is that you have to be within a certain percentage of the poverty level. If you think that this might be something you're interested in, reach out to East Cooper Community Outreach. They are this wonderful organization picked this program up. It was unfunded in our area, in our state for many years. And they wrote the grant, they secured the funds, they're implementing the courses. Just cannot say enough good things about this organization. So if it's not for you, consider supporting them. So where else do you go for small business capital? Well, oftentimes entrepreneurs will go straight to family and friends. And all we want to say here is just make it official. Find a note, make sure everyone understands how those funds will be repaid. Because once it leaves, money goes from a family or friend to a business, it's a business transaction. It's no longer just family and friends. If anyone's taking this workshop and you think you're going to be in front of venture capitalists, you're probably way ahead of us and you can drop off now, because those are funds where we think it's an existing business and we think it's immediately going to scale, probably be traded on the stock market soon. One of those really high, fast moving businesses. What we want to talk here is angel investors, and not the angel investor groups. They're a lot like venture capitalists, much like Shark Tank. What we want to talk about here is the individual angel investor, someone with wealth that wants to invest in small businesses. They can do it one of two ways, with debt or with equity. Debt is just that, it's a loan. Just be cautious of interest rates and be really cautious of too short of a term. You don't want to borrow money and then the monthly payments are so high because the term is so short. Equity investing is something that's a little trickier because entrepreneurs tend to be impatient. And so if they see capital and they can get their project off the ground, they're tempted to give too much of their business away. So your business is going to have a couple of friends, and one of your best friends will be your CPA. The CPA will be able to help you really put a value to your business so you'll know how much equity to give away for what dollar amount. Oftentimes it's really easy, and it's becoming more and more prevalent. It's just easy to go online and fill out an application, and you can really have funds if approved in about 48 hours. However, if you go to a bank for a personal loan, a car loan, a credit card, a mortgage loan, they have to give you something that's called an annual percentage rate, or an APR. That is the true cost of borrowing funds. Small business lenders do not have to do that. They're not under that regulation. So sometimes we'll see an existing business come in and they want to refinance their fintech debt or their online debt, and they think that their interest rate is around 14%. But when we see the term and we see the monthly payment, when we start unraveling how that interest is compounded, that 14% is a lot more 40%, and it's totally legal. So this is one of my favorite charts. It shows you the hardest loans to get are the least expensive loans, the bank loans. That's the green over there on the right. The LDC it has micro loans where that mustardy yellow in the middle, a little bit more expensive borrowing from a bank, but not nearly as hard to get. On the left-hand side, the cash flow loans, that can be immediate money. Some salesperson will tell you, just give me your last 3 monthly checking account statements or your merchant machine statements, and we can solve all of your cash flow woes. Because this is the most expensive money. We've seen it north of 90%. And the daily payments come out of your checking account before you wake up in the morning. And they typically don't allow outside funds like an LDC loan to pay off their debt. It has to come directly from your checking account. So if it's too good to be true, it probably is, right? If you have a story to tell, crowdfunding could be an option. This is where you go on one of these platforms and you tell your story and you give away little goodies for people to invest in your business. The LDC recently had a great success story with Swank Desserts in Somerville. She was a caterer and working out of a commercial kitchen. She wanted to open her own shop, and she knew how much that would cost, and she didn't want to borrow that much money. So she took a portion of what she needed and she put it out on one of these platforms. And, someone would donate $25 and I think you'd get a cookie or something like that. She immediately raised all the funds that she put out there and she got great publicity. Hey, I'm opening a bakery in Somerville. And then she was able to get a smaller loan. So her monthly payment is much smaller. So if you have a story to tell, this might be an option for you. Buyer beware, do your own homework. These do have fees that are associated with them. And some of these sites, if you say you need to raise 25,000 and you raise 24,000, they give all the money back. So do your homework. There's even marketing agencies that specialize in setting these pages up for you. But if you're just a regular business and you just want to go the old fashioned route and get a loan, a lot of people think you need an SBA loan. Well, the SBA does not lend to small businesses directly, except in times of disaster, but just as a normal small business loan, the SBA provides a bank with an insurance policy. If the bank approves it, then they send it to the SBA. The SBA will then approve, yes, it's eligible for this insurance policy. And it's the borrower that pays for that insurance policy. So there's some fees associated with an SBA loan, but it does provide capital that the bank would not have provided otherwise. So how do you get started with all of this? Really, it is the business plan that is so important to lenders now. They want to know that you understand how much you need to borrow and what those funds will do for your business so they can anticipate getting repaid. This is the LDC's definition of a business plan, what we want to see in it. And it really is just a summary. Please do not buy any type of software. There are great templates that the SBA has, that SCORE has, the SBDC has, all for free. So don't buy software. Just let us know what is your business, who are its customers, what kind of staffing do you need, what are your qualifications to run it profitably. This is the SBA's definition of a business plan, and it is all about the numbers. They want to see a balance sheet, income statement, and cash flow analysis. We just say it needs to be clear. One of my favorite business plans was a young man who was a landscaper who was mowing people's lawns, fell into a commercial opportunity and needed an enclosed trailer and a couple pieces of equipment. His business plan was on notebook, paper, and pencil. But he demonstrated that he understood his business, he understood seasonality, he understood cash loan. It was a great loan. It was 10 years ago. He's still in business with 2 crews. How is your business going to grow? If it's not going to grow, stay a mom and pop. That's great. Just how is it going to sustain itself? And then who is on the team that can run a profitable business? You may have the best recipe for a cake and bake the best cake in the world, but you really don't know how much you're spending on the ingredients or your time, or maybe though you have a family member that's a CPA or a bookkeeper and they can help you work through some of those things, and they're not going to charge you anything, but maybe a cake once a month. Include those people in your business plan. It's not necessarily the people that you pay. It could be your long-term mentors. And then we really want to know that you understand the waters you want to swim in. There's something called a SWAT analysis. And in your business plan, that's where you list your strengths, your weaknesses, your opportunities, and your threats. People are really good about talking about their strengths and their business plans. You're like, why would I tell my lender about my weaknesses in my business plan? It's because if you don't address them, then we're going to guess at them. So small business lending tends to be a little gloomy, and it's always the what if. But if you address the weakness and your strengths overcome them, then we get that. The same thing with opportunities and threats, but these are things that are outside of your control. There's an opportunity in the market for my business to thrive because of XYZ. I understand the threats of the competition, of seasonality, whatever it may be. And then we need to know that you understand how much you need to borrow. We'll get a call in about a small business loan, and we're like, sure, how much do you think you need? Somewhere between 50 and 100. I'm really not sure. Those people are nowhere near ready to call a lender. But when we get an application in that says, I need $73,486.19, that's a little too specific, but we like that one a lot more. And so we do need to know that you understand exactly how much you need, and we're going to see that with the pro forma that you give us. Once we get an application, how do we underwrite? And there's something that's called the old-fashioned 5 C's of credit, where we look at your character, your business's capacity, the collateral that you're offering, the capital that you've injected in it, and then the conditions. First of all, your character largely is, can you run a profitable business, and do you typically pay people back? The first thing we will look at is your personal credit history. A lot of people will give us the Credit Karma, Credit Wise, whatever that may be, those free sites that you can check your credit score. And they appear to be about as valuable as what you paid for them, because someone submitted a 671, I think, and it ended up being like 613. I mean, it wasn't exactly that, but it was more than a 50-point gap. If you really want to know what people are saying about you, there's a government website. It's Annualcreditreport.com. You can visit it free once a year. So do it on New Year's, do it on tax day, do it on your birthday, whatever is meaningful to you, because you do want to see what people are saying about you. One of the most common things that surprise applicants is medical collections. This is where you go to a medical provider and you get this confusing statement from your insurance company that said the medical provider charged $100, we cover $75. So there's $25 left over that sometimes is forgiven by the medical provider, and sometimes it's not. And they're notoriously bad billers. So all of a sudden you go to apply for a small business loan and your credit score has dropped 50, 75 points because of a $25 medical collection that you didn't even know that you had. So do keep up with your credit history. Part of your character is your team and your ability to make a profit. We also want to see your resume, because in the business plan, you tend to talk a lot about what you're going to be doing in this specific business. But the resume gives us a much broader view of who you are, your experiences, your education, things like that. And then we do want to see prudent spending, that you haven't been spending more than you've been making. As a matter of fact, we'd like to see that no more than 40 cents out of every dollar that you earn has to service debt. And then we want to see a personal financial statement. And if you've never borrowed for a business before, chances are you may never have filled one of these out. This is where you list everything that you own on the left and everything that you owe on the right, and what's left over is your net worth. Now, if you don't have a lot of assets, if you don't own real estate, that net worth could be a negative number, and don't let that make you nervous. It just is what it is, right? What's really important is on the second or third page of a personal financial statement are schedules. And this is where you probably will start and then summarize the information on the first page, because this is where you list your assets. You tell us what it is, what you think it's worth, why you think it's worth that, and if there's any liens on it. Then there'll be a schedule for other debts. And this is any unsecured debt, like your credit cards. Maybe there was a loan that you took out for home repair or a new air conditioner. And then there's student loans. Even if they're in deferment, we need to know what the monthly payments are. And that's because we just assume your business is going to be so successful that you're going to have to start paying those student loans back. If this personal financial statement is not filled out completely or correctly, this is really a character test, because if you don't fill out your personal financial information correctly, How will you be keeping the business's books? So please make this attention to detail. Next on our deciding factors is capacity. And this is just simply, can the business pay its bills when it's due? Is there any discretionary cash available? Really, in a startup situation, we're looking, is there any outside sources of income that can support the business owner until the business is permanently profitable? So how we're going to see that is with that pro forma that we talked about. And I'm going to go through this kind of quickly. It's an example, a really simple example of a pro forma. SCORE and the Small Business Development Center have hour-long workshops on this. So just bear with me. If we're looking at this retail store that has two products, product one does really well in the warm summer months. Product two does really well in the cold winter months, in so much that in the off season, we even have to discount the price of that. So in January, we only sold 100 of product one, but we sold 500 at product two at top dollar. But that's just gross sales, right? So we had 8,500 in gross sales. It cost us something to sell those things. So there's a cost of goods sold. So we take our gross revenue less our cost of goods sold. Now we have a gross profit of $7,300, but we have to pay some bills. It could be rent, it could be insurance, it could be employees, it could be cell phone. All of these things could typically be stable numbers. I mean, if your business has some seasonality to it, there might be some months that are higher than others, but it's typically stable. So we've got our gross profit of $7,300. We paid our bills. Now we have a net profit of $2,335. That's real profit. That's your business making money. Now look at April. It's not really hot or cold in April. So we're not selling very much at all. As a matter of fact, we lost money by opening the doors. That's why the cash flow projection is the most important part of the pro forma. What we're doing is taking how much money we have at the beginning of the month. We're selling some things, but it cost us to sell those things. And then we pay our bills. And that's what's left over at the end of the month. When you, especially for a startup situation, when you come in with your application and you're looking at the project to get open, it's really your loan officer's responsibility to also do cash forecasting with you to make sure that you don't have a cash deficit until you get to a point of consistent profitability. All right, next up is collateral. And this is back to the doom and gloom of a small business lender saying, if the business doesn't repay the debt, and if the business owner doesn't repay the debt, what do we have that we can liquidate in order to get our loan principal back? Now, you can't pledge what you don't have, but you better be prepared to take as much risk as you're asking the lender to take. Sometimes, especially for larger loans, I'll hear, well, I can't pledge my house. My spouse won't let me pledge my house. Well, what I'm hearing is, I probably won't pay you back, because it doesn't matter what you offer as collateral. If you pay the loan back, the lien will be lifted, the collateral will be released. So if you do have assets, you better be prepared to pledge them if you want a small business loan. What we usually can't take as inventory, as collateral, is inventory, except when we did a jewelry store in downtown Charleston, we kind of thought of that as collateral. Accounts receivable typically aren't used as collateral. There are specialized lenders that do nothing but accounts receivable lending. They're a little expensive, except for the LDC. If we see a contract, like a government contract, we're looking for kind of guaranteed ways that there's cash available to get repaid. We did have a guy that was making crab dip and got picked up by over 100 Harris Teeters, and he needed to buy a whole lot of crab. Yeah, we kind of saw that as a way that we thought we would get repaid, but so did a bank, so we didn't do that one. If someone else owes you money, we can't take over that note. Sometimes people will offer personal items like jewelry, and they need to understand they will be in a safe deposit box for the entire time of the loan. If you bought a timeshare and they told you it would build equity, we wish you the happiest of vacations, but we don't agree. And boats and other recreational vehicles that are not used in the business have a habit of disappearing if times get tough. So we don't take that as collateral either. But the business will have assets, right? So the first thing you typically give a business is your phone, your computer, some furniture. What a lender can do to take those types of things that a public lien cannot be placed, like a mortgage or filings with the DMV. There's a filing with the Secretary of State called a UCC. And this is just a public statement that says, hey, to the other lenders in the world, we have a loan to this business already. And so we've taken the business's assets as collateral. You may have a great relationship with your bank and you have a project that you really need to borrow $50,000. And your bank says, hey, you know what? We value your relationship. We can't go that high, but we can lend you 10,000. Make sure that they are not placing a UCC to secure their $10,000 loan. You still need to borrow 40,000 to get your project fully funded. And the larger lender then would not have the business's assets as collateral. So be really wary about that. Something that can mitigate the need for collateral is a personal guarantee. Every owner of the business that has 20% or more ownership will be a personal guarantor. But there also could be a guarantor from an outside source. There could be, well, we had a young man that had an idea and he truly needed $100,000 for this business to be fully funded. And he rented an apartment. He was still paying on his car. It was a good loan though. And it was lots of jobs behind it. He went out and got 10 people that did have wealth, that did have liquidity to become guarantors. What they basically signed was a document that said, if for any reason the business and this young man doesn't repay the debt, I will repay 10,000 of it. So that's an outside guarantor. And to have 10 of those at $10,000, that spoke a lot about his character too. So this is the page out of our application. And if it's blank, the application process stops because the business has some assets. Restaurants will give us a list, an attached list of all the equipment that the restaurant has. What we need here is a description of the items being used as collateral, present market value, supported with documentation that tells us why you think it's worth that, and if there's any loan information on it. So again, if it's blank, application just stops. All right, next up is capital. And basically this is how much money is the business owners putting into the project, and are they using the money wisely? We had an applicant for a startup nail salon, and she wanted to borrow $250,000. And we were like, whoa, it does not cost that much to start a nail salon. What are you doing? So we got into her construction budget, and it was marble this and silk wallpaper that. And I'm sure it would have been stunning, but it wasn't good, reasonable expenditures. So we paired her with a general contractor as a mentor. They got the budget down to $98,000. Still one of the best looking nail salons in Charleston, but we made sure that the expenditures were reasonable. So I haven't updated this slide. We talk a lot about being in a pandemic, but not a lot about being in a recession, and banks really have gotten tighter. They want to see about 30% of the project costs in the business owner's checking account out at time of closing. You may have heard the old adage that 4 out of 5 small businesses fail in the first 5 years. And that's not exactly true, although 4 out of 5 are not still in business after the first 5 years. And that's because owning a business is hard work. And it's not just that there's no more vacation days, no more sick days. It's because there's no more boss. And you're like, wait, I'm starting a business because I don't want a boss. Well, it's because the decisions you have to make are really, really tough. Who to hire, who to fire, how to negotiate with a landlord, how to negotiate with city inspectors, how to choose your vendors, how to keep cutting the budget. All of those things are stressful. And a lot of people just say, hey, you know what? I didn't know it was going to be this hard. I'm going to shut down. However, the more cash you have in your business, the less likely you are to choose that option. And then after 5 years, the business is pretty much running itself. And it's not nearly as so stressful. So that's why lenders see less risk. The more money you have invested in it, the less likely you are to walk away. So, but we do want to make sure that you're capturing all of the costs. Make sure that you are giving yourself credit for what you're giving the business, whether it's furniture, equipment, that type of thing. This is a page out of our application that can look confusing when it's blank. So I just wanted to walk through this really quickly. This is a $57,500 project, but the loan that they're asking from the LDC is only $20,000. That's because they found a specialized equipment lender, and the owner has $7,500 worth of equipment and $10,000 in furniture and fixtures. And he supported this document with values, quotes, that kind of thing. But for this $57,500 project, $20,000 from the LDC for leasehold improvements and working capital. The rest of it, he is either investing or he's got the other equipment lender. Another way that we're going to look at how much money you've put into this is through your balance sheet. And just like the personal financial statement, what you're listing, only this time it's vertical, all the assets of the business minus the liabilities of the interest. And what's left over is how much the business owner has put into the business. If this is a negative number, we're going to wonder, did the business owner invest enough in the business? Did he take out too much money of the business? Are they using the funds correctly? We're just going to have to look at this a little deeper. And you can't give us too much information. So do document, so we'll know that you truly need this amount of money. Quotes, just even an eBay page. It may not be that piece of equipment that you end up getting, but at least we'll know what the market is bearing for that. All right, lastly is conditions. And if you do a SWOT analysis, you'll probably address all of this in your opportunities and threats. These are things that are outside of your control, but you understand that you have to deal with these. And do include a part about disasters, not just hurricanes, earthquakes, but also pandemics. And then if you already have some corporate documents, include that with your application package. You know, if you already have filed with the Secretary of State, if you know where you want the business location to be, if you have a lease, if you have a letter of intent, or even if you just have a description of what the business needs for a location, include that. And an operating agreement. If you're a partnership, if you have more than one owner that has 20% or more, you have to have an operating agreement, even if it's two spouses that are running the business together. Here comes the doom and gloom again. We're just going to assume you guys are going to get a divorce while you still have the loan. And the operating agreement protects all owners and their rights. So if somebody does want to leave the business, sell their portion of the business, the other partner has rights. And then we need a communication from a traditional bank declining the request. It doesn't have to be formal. It could be an email to one of our loan officers. Hey, please help my good customer. They're opening a restaurant. We don't do startup loans. If you have any problem with getting this, please let us know. We're happy to talk to the bank. Although I will say it's the bigger banks that we have the biggest problem with this. And, this is my short little soapbox speech on small businesses should be with small local community banks. I mean, I think that everyone saw how the big box banks treated their small business clients during this pandemic and really left them hanging. So I hope as things are opening back up, most small businesses will choose to move to a small community bank. And I hate to be an ageist, but I like to have a small business lender with a little gray hair with experience. Some of the big box will hire folks right out of college, throw them through training, give them a hefty commission schedule and put them on the front line. So they would accept an application from a startup restaurant, not knowing the bank is never going to be able to do that and wasting weeks of your time. So be careful who you partner with, not just for convenience and location. Please understand that a small business loan does take some time. We really are business plan lenders. We really want to get to know you and your business. So give us some time. I'm not even going to give an estimate these days. I think everyone kind of spent the pandemic writing business plans, getting prepared, and there's a lot of businesses that are opening right now. So we're very busy. And who do we lend to? Of course, they must be small businesses. Really, it's just the only industry we cannot lend to at all are people that are flipping houses, that are buying residential real estate, improving them, and hope to sell them for a profit. We also can't do anything sin-based, but you're going to see in a few minutes that we got boozy for a while, did some breweries and distilleries. It's really just gambling, adult entertainment, that type of thing that we can't lend to. And anything that's going to get one person rich. We had a guy that invented something, was having it manufactured overseas and drop shipping it to Lowe's and Home Depot. And it just wasn't making an impact in South Carolina. Our board decided that type of opportunity, because there's no jobs, because it really wasn't doing anything for South Carolina, that was an investor opportunity and not a loan opportunity. Must be located in South Carolina and must be unable to fully secure funds from traditional banks. The LDC will partner with banks sometimes to gap finance. Loan committee meets the first Wednesday of the month. However, because of the pandemic and everyone knows how to use Zoom now, they really are meeting a little more often. But anything under 50,000 can be reviewed by staff, and staff may then be able to approve it, or it still may need to go to loan committee. Really, we lend up to 200,000. However, there's a lot of jobs behind it. We can go higher. Commercial real estate, we say up to 250. That's why usually we're working with a lead bank to provide that gap financing. Banks tend to love owner-occupied real estate, but have a hard time with the fuzzy working capital part. So we can help the small business owner with the down payment and the stuff that really makes the small business secure, that working capital. We do have seasonal lines of credit. Full disclosure, our interest rate is 9% plus risk. So the riskier the loan, if there's weak collateral, if there's a bad credit score, those types of things, it might be a little higher. Usually it's around 10.5 to 11.5. I'm sorry, we do have fees that are associated with our loans. There's an application fee of $125. And then if the loan's approved, there is a 3% origination fee and a $200 annual processing fee for some of our large loans. How we're different is our flexibility. This slide should just kind of be in gray because we do break our own rules. We say our minimum credit score is 575, but we just did a loan for a business owner whose credit score was in the 400s. But that wasn't because he hadn't paid people back. It was because of medical collections, and he didn't have any other open credit. He was renting an apartment, still had a car. I mean, didn't have a car loan. His car was paid for. So the only thing on his credit was the medical collections. That's what made it so low. There were no open judgments, collections, liens, bankruptcies in the last 3 years. The LDC understands that small business owners are human beings and life happens to human beings. People get in accidents, people get sick, people get divorced, people lose jobs. A lot of things can impact a credit history. What we want to see is stability. I mean, I was doing really great, then life hit me in the face, but I'm stable now and I'm paying all my bills now. Then fine, we understand that. Just write a little paragraph, submit it with your application. Don't let that be a surprise to the loan officer. Make sure that you've addressed it. I wish we could say we had collateral, 110% collateral on every case, and we don't. We will look at it on a case-by-case basis and see how to strengthen the deal to get it to approval. And terms, we do tend to long-term our loans. If you have a piece of equipment that has a 5-year lifespan, you don't want to finance it for 5 years because you could still be paying on it when you have to replace it, right? Except that the LDC does that all the time. Because all of our borrowers are businesses that are distressed for some reason, so a bank wouldn't make the loan, we want to make sure that our payments are as low as possible to fit within the anticipated cash flow. The LDC loans do not have a prepayment penalty. So after the business has been profitable for a couple of years, they can go get it refinanced with a bank, get a lower interest rate so the payment can be lower. And we'll just revolve those loans for the next small business that can't get a bank loan. And owner investment, we're different because we look backwards. When we were talking about how much a bank wants you to have in the project, the LDC will actually look to see what you've already put in to the project. We had a young woman that had known her entire life. She wanted a retail clothing store. When she was babysitting, she saved her money for mirrors and rugs and chest of drawers and displays. So by the time she was ready to open and had cataloged everything that she'd purchased, it was about $25,000. And she gifted it to the business, so that was her owner's investment. Well, what also happened is all of a sudden the business had some assets to use as collateral. So that's an example of how we look backwards at how much the owner is putting into the deal. This is a little hard to see, but this is how we risk rate every loan. We have 10 different categories that we risk rate on a scale of 1, which is excellent, to 5, which is unacceptable. They really do follow along the 5 C's of credit because we're looking at the character with your personal net worth, your credit score, years in the industry, years in industry management. Then we are looking at capital. We are looking at capacity with a couple of ratios. So at the end, when we take the score, the LDC's average right now is around a 3.2, which is just between acceptable and poor. If you decide to apply for a loan, this is our website where you can, on the right-hand side, download our application. It is interactive, so you can fill it out online. Then you'll see a checklist with that application. If you check these boxes off, you will have a complete application package. Behind that, you're going to see a bunch of disclosures. So I'm going to run through it in about 45 seconds. So it's really written in government ease. So if you have trouble sleeping at night, this is a good read. And first of all, funding requirements is everything that we just talked about in this application workshop. On the second page of the funding requirements will be a place where we need you to list the name of the financial institution and the lender that you spoke with there that was give us that communication that they can't approve the loan request, only because this is going to get separated from that communication. Minimum credit requirements. We just talked about that. We talked about the collateral requirements. This disclaimer says that as you work with the LDC staff, they may give you some business advice. And if they give you business advice and you take it, you didn't think it was good advice, you won't sue the LDC and you won't sue the loan officer. I promise we try very hard not to give bad advice. This one says that you don't have any friends or family that would sway a loan decision. But even if you did, they would recuse themselves for any loan discussion. So let us know if you're worried about that one. Certifications and assurances, you're basically telling us that you are legal to do business in the United States. And this one says that you are not debarred from doing business with the federal government. And honestly, it's student loans that we see the most often. If you've defaulted on a student loan, you've defaulted on federal debt. And so we would not be able to take your application. If for any reason you're afraid of that, just make sure that those student loans are back in a payment plan, and then we can take it. This one is basically giving the LDC permission to use your business's name and logo, and maybe a couple of pictures in our marketing, in our promotion. And this one goes over the fees that we talked about in this workshop. Once you think you have everything together, we do have a secure server. We want you to email as much as possible. Let us kill the trees. We know what part of your tax returns we need. If we have your business plan and your projections, we can go through those with you and we can see the formulas. But once you've emailed everything and you've gotten the green light of yes, your package is complete, then we want to set a time to, when you get assigned a loan officer, to go through the package together. We really want to make sure that we understand everything that you've given us. If we have questions about it, if you want to have your coach or mentor sit in on that, we'd love for that to happen. Right now, the LDC's offices are closed. We're reopening to the public on June the 1st. But now that everyone knows how to Zoom and Microsoft Teams and these things, we will still have a lot of virtual meetings. We could not process as many applications as we do without the help of SCORE and the Small Business Development Center. They both offer free business consultation services. SCORE is made up of volunteers. The SBDC has a full staff. They're both supported by the SBA. So I recommend using both of them. It's a free opinion and you would get great support from either organization. This runs just a little long, but these, we're not ashamed of it. We're very proud of all of these businesses. Hopefully you're going to recognize a couple of logos. Hopefully you will patronize some of these businesses, because at one point they were in your shoes where they had a great idea, but they were unable to find a bank that would give them the capital to get started. And then they found the LDC. Okay, so thank you for attending the application workshop. What we have started recently is we're having loan officer virtual office hours. So basically, the loan officers at 10 o'clock are going to jump on a Zoom. And if you have questions about this workshop, jump on, and they are just there to answer questions. If you found this, well, go to our Facebook page and we'll have a schedule and a Zoom link for you. If you found this slide deck helpful and want copies of the slides, please email info@charlestonldc.org. Natasha is our intake specialist. So she's going to help you assemble your application package, make sure all of the pieces are in place before you're assigned to a loan officer. And you'll see our phone number there. So again, thank you for attending the workshop, and we look forward to seeing your application.